Um, so First, I'd like to wish everyone a happy Father's Day. And secondly, sorry I wasn't able to make the UK trip. It looked like an amazing program and a great group of people. There's a lot going on in the world today, and it really is getting even more difficult to make sense out of what's going on. You have the US and China trying to put guardrails on their relationship to stop it from really going off the tracks. You have central bankers trying to rein in inflation in some cases and trying to stimulate their economies in others. You have corporate executives right now trying to figure out how to navigate the shifting tides of global trade. And at the same time, we're all trying to answer several questions, like how and when the war in Ukraine will end, how we manage the clean energy transition, how will governments fund all the required spending given the strained balance sheets that they have? How will global trade work in an economy that's reorienting production? How will consumers adjust to higher costs of living, which we think are going to be with us on a more permanent basis for some time? And finally, what does this all mean from an investment perspective? So what happened last week? We had the Fed pause with more hikes projected. You had the ECB raise with more hiking to come. You had the People's Bank of China cut rates, and then you have Australia hiking rates. You have the UK still hiking rates, but you have other parts of the emerging economies starting to look at lowering rates. So you have a multi-speed economy that's creating some real challenges. So the Fed's actions was a bit confusing last week as they hit the pause button while saying they still think two more rates hikes are likely. I think part of that is designed to talk the street up. If you recall, at the start of the year, the street was looking for 4 rate cuts this year, and the Fed has been trying to move them off that. And I think they finally succeeded in doing that. But they still think there's some more work to be done. So the question is, why didn't they keep raising rates now? Why did they take a pause? And I think that the reason they took a pause is they think they might have done enough. They're not sure yet. So they're going to wait another meeting, see how the numbers come in, because inflation is coming down, but it is staying a little bit more persistent in some key areas. And I think the thing that's throwing everyone off is that it's the headline inflation that's come down a lot. You've seen commodities come down, you've seen energy prices come down, but you haven't really seen you've seen wages go up. You haven't seen the hits to the labor market that you would normally associate with a more difficult economic environment. The ECB, after the Fed announced their move, followed with a hike, and they believe that they have really persistently above target inflation levels, and they're worried about what happens in the fall for them. But the PBOC is really a reflection of a very different kind of Chinese economy than we're used to coming out of the pandemic, where here you're seeing China being much more domestically focused and much more internally oriented in terms of where they're supporting, and very targeted, as opposed to mass stimulus that's going to help the whole global economy. And the old thought was, we help the whole global economy. We're the world's largest exporter, it helps us. Now they have domestic problems that are really changing their narrative. So you can see 3 different policy actions, 3 different directions that economies are going, and 3 different problems that these guys are central bankers are dealing with, and how do they navigate this. So let's take a look at each country or each region as we go. So you can see in the US, this is the current assessment of the US economy. So listen, the economy is doing okay. The rate environment is not too restrictive, but it's restrictive enough. So the economy is still expanding at a moderate pace. The problem is the job market is way too robust, and employment is way too low for the Fed's needs. You also have, it's hard to remember now that we had a banking crisis a couple months ago, because it's barely being talked about these days. It shows how resilient the system's been. Not that we're dodged the bullet, that we still have more to go there, but I think this is an area that we're going to continue to see more discussion on, but we're not out of the woods there yet. But certainly from where we were in March to where we are now, very different system. The tightening of credit has been going on, but it hasn't been to where it's so restrictive that you start to see a massive slowdown. So really the Fed needs to look at where we are, but here's the problems that they're facing. Inflation is coming, it's too high, but it is coming down, but they're way above their target here of 2%. So that's going to take some time for them to get past that. And this has been an issue for Duncan. He's raised on the last couple of calls, is the 2% target real or not? It doesn't matter right now whether it's real or not. The Fed will not change the target until they get past this inflation cycle. And I doubt the ECB and other central banks will either. And the reason for that is it would create a panic in the market and create more inflationary fears than it's worth at this time. So we'll probably address it, but they're not going to address it anytime soon. So this is part of the problem. Inflation is too high. And it's in part because the labor market is so tight, it's keeping wages elevated. But the other problem that the Fed has is that productivity has declined since the start of the pandemic. And when you would have thought with all the advances in technology and all the great breakthroughs that we've had, that productivity would be rising. And I think this is a function of the distortions in the economy where we threw so much money at the problems that you didn't have to focus on productivity. You really had to focus on really just getting money to work as quickly as you can and dealing with the crises in front of you, where now we're starting to look at the longer term productivity, and you're starting to see that in a lot of the policies that have been put forth. So this is a big problem for the Fed. They need to see this reverse. It is starting to trend upwards again, but we're in negative productivity growth here. So that's not a good structure to be in. But there are a lot of positives going on. And we've talked about the 3 legislative acts, the Inflation Reduction Act, the CHIPS and Science Act, and the National Defense Authorization Act, which have all stimulated capital flowing back to the US. What this chart shows you is the red dots are semiconductors coming back. The greenish dots are clean energy. The square for blue is, dark blue is EV batteries. The light blue is biomanufacturing, and the gold is heavy industry. You're starting to see a lot of money flowing back into the US, both from our own companies, but from foreign companies coming back in and foreign governments coming back into the US, creating a big opportunity for the US to move forward. So we think this is kind of the conflict that you're seeing of tight labor markets with high inflationary pressures there. Even though headline inflation is coming down, core has been stubborn. And you're seeing this transition of the economy benefiting the US, and just this, $500 billion is on top of the several $1 trillion of those 3 acts that have been put forth. So now you're looking at $4 or $5 trillion of spend coming over the next decade against a $25 trillion economy. Pretty impressive opportunity for the US, and why we're less concerned about where things are going and why we're more positive on capital continuing to flow here. And Andy, I think to your question earlier, I think that's part of why the market seems to be a little nonplussed by what's going on with the Fed, is you have these contravailing forces of massive capital flowing, but a very stubbornly persistent and low unemployment rate with lack of productivity. So as productivity improves, as capital continues to flow back, I think you'll see unemployment come up, but you'll see a more productive US system, and that should bring inflation down, create some other issues that we're going to have to deal with on the people that are displaced, but very positive for the US. When we go to Europe, it's a very different story. They had hiked 25 basis points to 4%. Keep in mind, Germany had a 10-year that was negative 62 basis points or 52 basis points about 14 months ago. Now we're moving up to 4% rates for the ECB with more to come. Inflation's coming down, but still way too high. And what's come down a lot is food and energy, but wages are still too high, and we're worried about food coming back and energy coming back in the latter part of this year. Well, you also have some policy mismatches where we're forcing the energy transition on before the system's ready, which is going to keep inflation elevated and will also create some weakness in the economy to the point where I would say that Europe's done much better than we thought, but the weakness is still there. And it's kind of this lethargy that you're seeing out of the economy where you have this very tight labor market, higher rates are starting to work through the system. But the big issue is the manufacturing weakness that I think is going to accelerate. The reason for that is twofold. You have really slow growth projected for the region coming for the next couple of years. And these are pretty anemic growth rates that, looking at getting to 1.6% as you come out into 2025 from below 1% now. And you're doing that off of inflation that's well above the Fed's target and the ECB's target. And they're projecting it to get down there in 3 years, but I'm skeptical that that actually happens. And the reason for that is I think there's going to be a bit of a carving out of the European manufacturing base, and particularly the German manufacturing base, which is the big driver for the European economy, without anything to backfill behind it in a meaningful way. So I think when you look at what's going on there, and this is a statement from the European Roundtable, 57% of company CEOs believe that they are eyeing shifting investments or operations of both across the Atlantic in the next 2 years. And the reasons for that are multiple. You have a regulatory and incentive framework that is very difficult in the ECB. You have high energy costs with lack of dependability of energy supplies right now. As we're making this clean energy transition, you're seeing increasing fragmentation in the market and big divisiveness between the economic fortunes of the various countries and where they sit and how their competitiveness lies, and also how much burden they've taken on over the last decade in dealing with the problems there. And now you have China, who has been very aggressive in their domestic policies, now being matched by the US getting very aggressive with the Inflation Reduction Act. And now you see a competitiveness issue coming where the ECB has to really think about how did they get their corporations to and create a framework for their corporations to be so successful to attract foreign direct investment back into the ECB. And then you have that issue, and then you add to it, they have an over-reliance on China for trade. And how do they deal with that? And you're seeing this from corporate executives right now, where Siemens is talking about how do they face off with China. They're putting some of their production back into China and some of it into Singapore because they can't have all their cards in one market because it's too risky right now. And I think that uncertainty for corporate executives is making more permanent shifts in capital away from Europe, which creates a repetitive cycle for them that's going to make it more difficult. So when we shift now to China, which is a very different and quite honestly, one of the bigger surprises of the year of how their economy is operating, because we all thought they were going to reopen and that the reopening would be good for the global economy. But the instability inside of China and the vulnerabilities inside their economy right now are such that they became out of this much more introspective and introverted in terms of where their focus is. So they're working on stimulating the economy with a focus on stability. They have three big problems. They have a slowing growth problem, which normally is not bad when you're growing at 5%, but when you're slowing from 10 to 15% over the last 20 years, all of a sudden that slowdown gets hard to cover some of the sins that exist in the system, where when you have hypergrowth, you can get past a lot of those problems. So they have a problem inside their economy. There are multiple problems that are mounting, but the way they're focusing on this now is they're cutting rates, which is very different than the rest of the world. They're coming up with very targeted stimulus, which is going to focus on higher social payments, more local government financing and tax cuts. They're trying to do a charm offensive on business leaders, particularly US, and you've seen Musk and Gates and others going over. You've seen European leaders go over because they know they have to navigate the challenge of one of the largest and most attractive markets to sell into against an environment that's a very difficult one to navigate, both from a political and economic perspective. So that's a big issue that we're dealing with right now. You add to it that China's told the world which industries they view as strategically vital, which makes it very difficult for non-Chinese companies to go in and compete there, and creates some real dilemmas for companies. Micron's a good example of this. Micron is on the do not buy list or the barred from buying list for several Chinese companies, yet Micron's continuing to do a $600 million investment in their facilities there because it's a big market and they know they need to be in it, and they can be in that market for the non-vital areas, so the non-defense, non-industrial areas, and for commercial areas, but they won't necessarily play in the areas that are of highest importance to China. And the risks in China are growing, and they've been able to mask them by their growth rates. But as they get to this point now, they're having a different mindset. So you have deflationary risk, you have these local government debts that are growing quite rapidly. The property sector is a big driver for the Chinese economy, and that's in a very difficult spot. So they're focused on supporting the property sector. All this against a backdrop of weakening global demand, rising geopolitical risks, and the unemployment of their youth that we talked about before. And the problem that you don't know if you're in a non-Chinese company, how do you want to invest into the Chinese market? And just think about one of their champions, Alibaba, has gone through two of their original founders as CEOs now. The second one stepped down today. And the government is taking a much bigger role in participating in the runnings of individual companies, particularly companies that they champion. So that's one element of it. The other side of it is the slowing with a focus on stability. On the right hand of the chart, you see industrial output, which is coming down now year over year at a 3.5% rate, which is slower than they would like to see it. And then you have their retail sales slowing too. Not a great setup for an economy that's trying to stir domestic consumption and really navigate a very difficult time. Then we've talked about this youth unemployment of the last couple of months, and now it's peaked again. It's up another 0.4% to 20.8%, and they're graduating 11 million students a year. So this is a real issue where the social stability comes into play, because these people are going to have to take factory jobs, not a great setup for them. So you see China going one way, Europe going another, the US kind of in between. And then you have other countries like the UK going through a very difficult time where the projections as we move into the second half of this year are not really encouraging. They expect to see unemployment go up. They have energy problems that are continuing to multiply. They have a slowing growth, and their industrial base is getting carved out as well. And now you're seeing water temperatures in the North Sea starting to rise very dramatically, which then sets up for a very difficult winter when you have, I think they're up 4 degrees in water temperature above the norm. And when you have that kind of a shift in water temperature, you tend to have very volatile weather coming. So we could be setting up for a period of very difficult weather patterns, which create some real disruptions on the system that really can't afford any big catastrophes coming. So keep an eye on the weather problems coming out of the UK and Ireland in particular, but part of the water problems in that part of the Atlantic could really flow through. So where are we? We have a polycrisis environment, which is creating big distortions and disruptions and divergences in the global economy. And really our jobs as investors is to sort out what matters in those distortions and disruptions and who's going to win and who's going to benefit. The other thing that's happening is we had, because of globalization, a lot of deep interconnections and interdependencies between nations and among nations that are now going through this major adjustment as we're redesigning how trade operates, how capital flows, and how strategic alliances are forged in the global system. And that's going to take years to work through. But in the interim, it's really going to create some more inflationary pressures. But at the same time, you have AI and work from home and the productivity push, which is changing the labor market and consumption dynamics, which are really redefining where you can see the clear opportunities for capital to flow. And for us, it's where the governments are getting behind in the US and China and other areas. They're really giving you a defined investment opportunity set and telling you areas you want to avoid because of their regulations or their focus, either lack of support or overemphasis on regulations in those areas. We think because of the US's unique position, its strong capital market system, its attractive interest rates, and its openness to attracting capital flows, that we're going to continue to be a magnet for capital. The uncertainty that exists in whether companies go ahead or don't go ahead with China is a real one. It's creating some dilemmas where you'll see really almost dual systems being set up. I think AstraZeneca is going to create two companies, kind of a Chinese marketed one and the rest of the world. I think you're going to see more of these splits going on that create dilemmas for CEOs where their decisions of where they're going to invest, how they're going to invest, where they're going to spend, what areas they're going to emphasize, who they're going to partner with, how they play in different regions is going to matter more. So this is a very challenging time for CEOs, particularly when you have inflation elevated and while it may be peaking in some areas. The problem is headline inflation is coming down quite a bit. Core inflation has been pretty stubborn because of the labor market dynamics. So I think we're going to see that persist for a while. Housing is still a big problem around the world. And as a result of all this, we expect wide divergences in earnings and profitability for companies. So choose wisely where you're investing and which segments of the market you're investing. And I think to a question that was posed before, we're in a 5% interest rate environment. It is very different than investing in a zero interest rate environment. And if we're not making those adjustments into our investment thinking and our investment theses, we're going to regret it later on, because a lot of companies cannot operate and succeed in a 5% interest rate environment, either due to their debt loads or their inability to maintain prices increases and pass them on. Because while we are seeing inflation elevated, it is coming down in certain areas pretty quickly, and that's going to lead to lower earnings and big divergences in earnings for companies. I'd also say this is an environment that favors the strong balance sheet, which is why the FANGs continue to do well in this environment, aside from the fact that they have real products that are changing the world. But when you have strong balance sheets and you can give up $6 billion of beta, projects, moonshots, and not miss it in your current business model, I think that really sets up the divergences that we have. So we're not negative on where we're going into the rest of the year, but we do think this is one where you have to be very circumspect about where you're putting your capital. And I would not be rushing money into the market right now. I would be very measured, gradually going in. But if you started the year thinking that you're going to see 15% returns on the S&P, raise your hand, right? Not many people were there at the start. I think the market will continue to surprise. It might not have that much more upside right now, but as we head into 24, I think we'll get through some of these near-term issues, and some of the investments that we made are setting us up for some very attractive investment opportunities. So Joe, I'm going to stop there and open up for comments or contradictions or questions.
Yep, let's do that. Questions, anyone?
Stephen,
Oh, there we go. So I'm going to go with our new friend Walter, because he raised his hand.
Thank you. I like this system. I like it. Yeah, I just want to reemphasize and I guess really highlight the fact that we are not in global concert when it comes to rates. The US is pausing to kind of see where the data brings it. The ECB is continuing to rate to basically tackle inflation, which, as you mentioned, is affecting productivity, it's affecting investment. And China is cutting because they see already that they're falling behind. They need to stimulate growth. In this environment, it's a local play that investors need to look at more than a global portfolio review, let's say. And until we see a concert of the three large regional centers, we're really going to have strategists all over the place calling for myriads of, as we in Florida call spaghetti, sort of a forecast. And that's a real risk, because yes, it creates a market, buys and sells, but it doesn't bode well for investors that are really looking for some certainty and some visibility. my question is, great presentation. Do you see this changing anytime soon?
I take a different approach in that I think you're right that I think the thing we had following the great financial crisis is we had a global coordination unlike any we've ever seen, other than really coming out of a war, right? So everyone was focused on stimulating the global economy and getting us out of avoiding a deep recession. As we moved past the first part of the crisis, then it became a European crisis. What was a US crisis became a European crisis. So you started to see the divergences hit there. And then China was still doing well, but the excesses of the system, of their supporting the global system, came back to roost on them. But I think aside from the US, I think there are a number of opportunities in Southeast Asia that are going to benefit from the shift. So I think it's still a global economy. I think globalization is changing. I don't think we fully deglobalize. I think we're kind of going through a reglobalization, a reindustrialization process, and that's changing where capital flows. But to me, the areas you want to invest in have been defined pretty clearly by the governments. Everyone knows you need to invest in the clean energy transition. How's the best way to do that is up for broad debate, right? Because it's not going to work the way everyone thought it was going to. Everyone knows that AI is going to create new opportunities. We just don't know how they play out. But you are creating a bifurcated global system or more because of the geopolitics and the interests changing for countries. So I do think this is very different, but I think there are defined areas. You can invest in digitalization, you can invest in electrification, you can invest in onshoring, which is happening and it's real, and reshoring and the shifts of what's going on. And you can invest in national security because every government now is out there very aggressive there. And, you know, Germany came out with their first national security plan, I think in their history. And, you know, they've been around for 20 some odd years now. So I think there's a lot of things shifting because of the geopolitics and because of the change in terms of trade. But I think the system is still a global system. I just think the shifts that we're seeing in the multi-speeds and the directions are more a return to a less coordinated effort. And now countries are really having to start to think, how do I deal with my own problems as a first? And I think that is a mindset change. But I don't think it's very different than we saw before from the actual globalization part of it. I hope that answers your question.
Yeah. Thanks, Stephen. So we'll go now, Tim, Joe, and then Adam if he's unless he doesn't have the question now. All right. Tim, take it away.
Hi, Steve. You mentioned briefly that China had decided on a number of industries that were strategic to them or important to them. I wondered what they were.
Oh, they have a 5-year plan. They do an update regularly, and they list the strategically vital industries. If you've never read China's 5-year plan, it is a masterpiece of a business plan in terms of its specificity and how they get there. But it's really around, and the FT has a good piece on this today. It's really around their military and industrial complexes, which they're viewing as pulling together and creating a big strategic advantage. It's also in moving up the value chain in technologies. They want to be in all the high value tech areas. It's being in renewables. They want to be leaders in that as well. So they have it defined. I'll pull out their old plan, and for the next meeting, I'll try and add it into the chat. But their 5-year plan is written not by poli-sci majors, but by engineers who are really thinking through the problems that they have. And it's really something that every government should have, regardless of the fact that they're not autocrats. It's a roadmap that is phenomenal for what a country should be doing.
Thank you.
Great. Joe?
I think Joe is next.
Yes.
Yeah, my question was, you've all probably seen the news about Buffett spending money in Japan. What are your thoughts about Japan, Stephen?
it's such a hard country to invest in because people have thought it was time to go back in a lot over the last 20 years. And now it's hit a 33-year high in its stock market. So it's interesting, he's buying in at a 33-year high. So he must have some confidence, but he's also buying in very specific areas, really around the exchanges. And I think what he's doing, if I had to guess, is I think as I understand it, Japan is actually looking at reorienting how their retirement plans work. And the exchanges would be the beneficiaries of a lot of capital flowing around. So it'll be interesting to see how long he stays there as well. But I never, for all the criticism he gets from a lot of investors in the business, particularly hedge funds and others where, Buffett's out of touch and all that, he hasn't really performed in a while. He's actually done quite well for himself. So I think he doesn't care how the market's doing. He cares about how much cash he's generating. He's finding cash generation opportunities there. And it makes a lot of sense. If you see a big shift in how their pension assets are run, you'll have trillions of dollars flowing through their exchanges, and he'll see some big benefit from there.
He plays a long game.
Yep.
He does that. Adam?
Thank you, Stephen. Great presentation. A lot of it, observation for me, just screams opportunity and opportunity with all of these disruptions and changes. Two questions I have for you is, one, recession. I don't see this coming anytime soon. And that's my question to you. When do you see this elusive recession coming anytime soon? And the second is the Middle East and the amount of cash that these sovereign wealth funds have there and the investments that they're making, not only in the Middle East, but abroad. What impact does that have? Those are my two questions.
Great. The first one is the Holy Grail, which nobody knows. I'll just say nobody knows. We're due for a recession, whether it's soon or not. It's very difficult. We've thrown so much money at the problem over the last couple of years that it's hard to get our minds around the fact that globally we've put 33% of GDP, $33 trillion into the system in the last 3 years. So that's still working through. So that's postponed the recession for some time. And why, with the rates moving up as fast as they did, we're still seeing growth surprising slightly to the upside. So I think we're due for one, whether we get that soon or not. I think that's as much of how fast the consumers run out of money and how much higher rates go. Right now we have, an employment market that's not supportive of a recession. We have too high an employment level right now. You need to see unemployment rise a lot before you can see a recession. So I think the labor market's still a little too tight for that right now. And the Fed not raising rates more, 5% feels high relative to where we've been, but historically it's not that high. So we can manage 5% rates as long as we don't have a massive reset all at once and a lot of things moving up, or the need to step in and bail out the system anytime soon. We're light on cash for that.
All right. Aaron, we're going to do one more question. And
Oh,
then,
I forgot the second part was the Middle East on that.
oh, that's
Jim.
right. That's right. Sorry about that. Yep.
The Middle East, I think it reminds me a little bit of when Japan was buying everything up back in the 80s, and everyone was worried about that too. If they want to buy Manchester United or, Live Golf or any of that stuff, I don't think that's really going to change too much about how we live. I think the bigger issue over there is how effective are the Saudis and is the UAE and other nations in diversifying their economies away from oil and getting into other areas of of opportunity for growth, and how well do they manage their youth and give them hope, because hope is a big part of the issue in the Middle East, has been for a long time, and the haves and have-nots there is a big problem. So if the governments don't have the coffers because of low oil prices to support their people, then they have the same problem that any autocratic type economies have, where without social stability, everything falls apart. So I think I'm not as worried about the issue of, are they buying a lot of stuff, is, are they diversifying their economies enough that they can maintain stability, because instability in that region is bad for the whole world. And it's pretty volatile right now as well.
Thank you, Stephen.
You're welcome.
Aaron?
Stephen, with the divergent interest rate strategy between the US and China, is there any talks or any fears of a depegging of the currency?
I don't think soon. I think what China's, if you think about it, China's gotten a lot of stability because they're tied to the dollar in a sense. So, if the US is doing okay, then it kind of helps them to be tied to the dollar the way they manage their currency to us. But I don't think that, I don't really see that as a real issue. I think I think they'll do okay. I think what they're trying to do more than anything is create these side pocket deals with strategic partners that slowly chip away at the dollar, and don't have them have to be a reserve currency, because it's hard to be one as an autocratic nation. It's virtually impossible. But if they can reduce the power of the dollar by creating currency swaps and other trade arrangements for things that they need to keep it out of the system in dollars, that has the same effect. And I think that's really the way they're looking at it.
Great. Well,
Um,
thank you for that. Oh, go
I have
ahead.
one for Duncan. I just wanted to follow up. Duncan's asked the question in the last 2 weeks. I don't know if you're on when I mentioned this earlier, Duncan, but on the inflation targets for the Fed and the ECB at 2%, I think it became clear over the last week that whether the Fed believes in the 2% target or not, they won't do anything until after this inflation cycle is done to move off it, or else they would panic the markets. I think they're not sure they can ever get to it, but I don't think they can say it. And as long as Powell, if he moved off it, he would send a message that inflation's worse than everyone thinks it is. And he can't afford to do that. It would undo all the work that central banks have done since 2008 to try and get the economy back on track. And with all the bullets that have been fired by fiscal policymakers, I don't see that they have the wherewithal to step in and provide a lot more support. So the central banks are at a level now where they could stimulate enough to help us in a recession in terms of the US. The ECB has to go up a little bit higher, and China is stimulating already, so they're already in that mode. I think you'll see more emerging market economies starting to cut rates faster, and more developed economies starting to continuing to raise rates. That's going to create some more strains in the system. And that's something to keep an eye on. If you have the emerging economies going one way, developed economies going another, and dollar debts become a problem at that point, that's a challenge for some emerging economies as well.
All right, Andrew, if it's a quick one, we'll do one more, and then I'll just give a brief kind of commentary, and then we'll probably call it.
Sure. It's not a question. It's just a brief introduction to a friend of mine that's joined the call today, Mitch Bollinger. He's a CFA charter holder and currently director of research at Middleburg Communities, and he's based in Charleston, South Carolina. So I've invited him to listen in today for the first time.
Great. Welcome, Mitch. Nice to see you. Do you want to do our customary 2-minute intro?
Yeah, sure. Thanks, Andy, for making the introduction and sending me the invite to this. A little bit of background on me. So I came from a engineering number crunching background, and I've taken a research path through my career. I've published a paper I published with a professor at the University of Chicago. Presented that to some universities around the world. I actually presented it about a year ago to a class that was being taught by a friend of mine at Oxford. So I sort of that intersection of research and practicality in terms of what I look at. What I find interesting is actionable research that you can actually use and is practical. I currently work for a company where a developer of multifamily and single family properties in the Southeast, but we have a certainly a view of the world and of real estate that is global, but we have a good idea of where we plug ourselves in. So when it comes to thoughts on commercial real estate, the state of it, what's happening there, I think I'm